JPX Energy Market Weekly Updates. Crude oil futures were trading lower on Friday as the sell-off took losses for the week to more than 7%, despite gains early in the session as U.S. inventory builds. A rebound in the U.S. dollar index also weighed on oil prices. The U.S. lifted interest rates by 25 basis points, while both the European Central Bank and Bank of England followed up on Thursday with 50-point increases. Followed by the rate rise, the strong U.S. job report sent the U.S. dollar sharply higher. At the same time, the U.S. industrial-linked factory orders dipped. It was highlighting more slowing in the economy, particularly on the industrial side, which is a negative for petroleum, especially diesel demand. Adding to the weaker sentiment, EI reported the drop of implied demand for distillate fuel oil, which is mostly diesel, for the week to January the 27th. Distillate stock in the United States are lower than usual, but have been ramping up recently after dropping to close critical levels late last year. A decline in consumption driven by lower industrial activity helped. There was also a crude oil inventory build of 4.1 million barrels for the week. This compared with a modest inventory increase of 500,000 barrels for the previous week. There was slightly better news from China, with services activity bouncing back into expansionary territory during January, as both supply and demand picked up after the country took a U-turn on its zero-COVID policy. However, investors have become less confident in the strength of the outlook. The crude demand outlook needs a clear sign that China's reopening will be smooth and the U.S. economic growth momentum does not deteriorate quickly. Helping to keep oil prices from moving further lower might be the European Union ban on Russian refined products set to take effect on February the 5th, potentially dealing a blow to global supply. The G7 in Australia announced February the 3rd that consensus had been reached on price cap levels for Russian origin refined oil products ahead of new sanctions kick in to ban EU countries from importing seaborne Russian petroleum products. Under the new agreement, the group will impose price caps $100 a barrel on imports of Russian products that typically trade at premium to crude, such as diesel, kerosene, and gasoline, and $45 a barrel on products like fuel oil that generally trade at discounted crude. The regulations will take effect with a 55-day grace period for refined products loaded before February the 5th and unloaded by April the 1st. The future market expects a calm transition as it had already priced in any immediate disruptions. Market traders, however, have warned that shipping logistics could prove more challenging as refined products that generally travel in smaller tankers search for fleet capacity. Expectations are that the embargo will tighten the supply of fuels, even though European buyers have stocked up as much Russian diesel as they could get their hands on in the past few months. On the product market, middle distillate cracks fell in all regions, with diesel registering more substantial losses than kerosene due to high refining activity and a slowdown in demand. Jet has proved the most resilient among refined product last week. The price of jet fuel traded above diesel in Asia for the first time since 2020, with China's emergence from zero-COVID expected to boost air travel demand. Dubai's discounted Brent narrowed an indication of strength for the medium sour complex, with the April Brent and Dubai EFS spread tightening to $4.13 a barrel Friday. Intermonth spread of the JPX Dubai sank after holding steady during the previous week, while the front end of NYMEX WTI forward curve flipped into a deeper contango structure. The first month and third month spread of IC Brent rallied on Friday, but still traded lower on a weekly basis. As recent risk-off sentiment persists in markets, we'll probably see a rebound in market structure and price premium for physical crude before the outright price climb again. Okay, that's all we have for this week. Welcome back next week.